What up, guys? It's Mr. Fit to Flourish, and today I'm going to be talking about how to short shares, or what you do, or what it means when you are shorting shares. All right, so let's get right into it. So I'm going to kind of show just a short depiction of what it would look like. Right. So the first thing that we want to know the first thing that we want to know is, what does it mean to short a share? So shorting a stock basically means that an investor is borrowing shares of a stock, so from a broker. So you're borrowing shares from the broker, and then you're going to sell them back onto the market, and then you're planning to buy them back later. And when you buy them back, you're buying it at a lower price. So when you buy it back at a lower price, you're making a profit. All right. So the basic formula that I like to kind of show people is that this is your profit when it comes to shorting a share. And when you're shorting shares, you're basically thinking that the stock price is going down. So you're betting that the stock price is going down. So people are always like, man, I can only buy stocks and make money when it's going up. No, you can make money when it's going down too. And the way you do that is you short shares. All right. And this is what you do when you short shares. Okay. So the short shares, pretty much the model is the borrow price. The equation is the borrow price. So the price that you borrowed that stock for minus the price that you sell it for is your profit. Okay, so you're the investor. All right, you're the investor. Let's say that you're gonna buy this stock, or you're gonna short this stock. Sorry, QUBT. Okay, so what does that mean? That means the broker is gonna let you borrow the stock. I'm not saying you're not buying the stock. You're not gonna pay $10 for the stock. They're just saying, here, take the stock and just sell it. You don't have to pay anything for it. Just take it and sell it. All right. So you take the stock and you sell it. That means you're borrowing that stock from the broker. Okay. So then you get this $10 credit. You get this $10 credit. All right. Then that stock goes down like we thought it would. That stock goes down to $8. Now you buy the stock back. So you have a $10 credit, but you buy the stock back for $8. So now, since you bought it back, you now have $2, and you give the stock back to the broker. The stock that you borrowed, you give it back to the broker. All right. So what just happened here? All right. Let's break it down again. So you borrowed the stock and you sold it immediately. All right. You borrowed it and you sold it. So you didn't buy it. Remember, you didn't buy the stock. You borrowed it from your broker. And that's what shorting is. People are like, yo, wait, what? Yeah, you can ask your broker, like you can ask Webull and say, hey, I want to short this. I want to borrow this and then sell it for cheaper, or buy it back for cheaper later. So this is what you do. You borrow that stock and then you just sell it immediately. And you made $10. So you get this $10 credit. So that's your borrow price. Okay. This is your BP, your borrow price. Okay, so it's your borrow price minus your LSP, your later sell price. So we said we borrowed that stock for $10, and then the stock did go down. So the stock went down. So now I'm just going to buy that stock back for $8. Okay, so 10 minus 8 equals my profit, $2. Now you might be saying like, okay, why would I do that? Well, because in this case, you only bought just one share, or you borrowed one share. Imagine doing this to 10,000 shares. Okay, so 10,000 minus that 8,000 gives you a $2,000 profit. Okay, so you could just pretty much scale this up. All right, you could pretty much scale this up. So let's review that one more time. Like, what the heck? Like, what just happened here? Okay, what just happened here? So stock, which is one share, equals, let's do it again, $10. All right. So again, you ask your broker, hey, I would like to borrow a share. All right. So again, you take a share and you sell it. They're letting you borrow it. You're not paying for it. Okay, that's the concept you need to get out of your head. You're not paying for this share. You're asking to borrow. They're saying borrow it. So you take that one share and you sell it. You sell it to the market. Now you have $10. Yet automatically now you have $10 in your account. Okay. And this is a borrowed $10. All right. This is a borrowed $10. So you're gonna have to scratch this this transaction somehow. Right. So now, or you have to. It's called like closing your position, closing your position. So you need to close your position because right now you that $10 is borrowed. All right. You still owe your broker $10 or that share. Okay, you owe them the $10. So now the stock price goes down like we thought it would. The stock price goes down from $10 to $8. All right. So now you buy it back. You're like, okay, it's cheaper than when I borrowed it. Now it's $8. So now that 10 minus 8, you're left over with $2. And you just give that stock back to the broker. All right, the share that you borrowed, you give it back to the broker. And because the stock price went down, you made $2. Because again, you borrowed for $10 and then you later sold for $8. You sold it for $8 and you made a $2 profit. Okay. Now what happens if the price doesn't go down like we thought it would? Okay. Let's take a look at that example. Let's take a look at that example. All right. So again, we asked the broker, hey, can we borrow? So we asked the broker, hey, can we borrow? Yeah, they give you the stock and you sell it. You sell it to the market, and now you have a $10 credit. Cool. $10 credit. All right. And we're expecting the stock price to go down, so now we can buy it back cheaper. But guess what? The stock price actually didn't go down. It actually went up. It went up to $15. Now you're like, oh crap. Oh crap. It's going up and it's going up fast. So you're like, all right, I need to get out of this position. I need to close this position. What do? Well, to close your position, you're going to have to buy back this stock. So when you buy it back, since the price is higher, let's do our formula. So $10 minus $15 equals negative $5. So now, instead of making money, I lost $5 on this transaction because I have to pay the broker back. Okay. So I'm actually not credited anything. I'm actually owing that $5. All right. So I'm negative $5 now because I borrowed it for 10. So I had a $10 credit. And now since the price is going up, I have to pay the $10 plus an extra $5 from my account. Okay. So I actually owe the broker that negative $5. Okay. And that's how short squeezes happen. So what is a short squeeze? A short squeeze is basically when these companies, they're borrowing the stock, right? I can stop sharing the screen. But short squeezes are basically when a company is shorting a stock. So they're borrowing the stock. So let's say they borrow the stock for $10 per share. And they think the stock is going to go down because if it goes down, then they have a $10 credit that they can use to buy it back at that $8. Now they keep $2 of the dollars. Okay. But what happens is they borrow for that $10 and then the stock price doesn't go down. It goes up. It goes to 11, then 12. And they're like, I'll wait till it comes down. It doesn't come down. So they're like, oh crap. I need to hurry up and buy the stock back and lose the $2 before it ends up going to like 20 and I'm losing $10. So then once you buy a stock back, it causes buying basically causes upward pressure because if you're buying, there's going to be people trying to bid to get that same stock. So like if you're like I'll pay 11, they're like I'll pay 11.50. So then it causes like a bidding war, and if you're buying back the stock, that's why it's called a short squeeze. All right, you have to buy back your short position, and the people are bidding against you, causing the price to go up. Okay. So anyways, that was a short explanation on what is it to short a share, short stocks. And again, it's just pretty much the borrow price minus the price that you later sell that that share back to the broker for. Okay, and that is equal to your profit. All right. So essentially, you're betting that that stock is going to go down. All right. You're betting it's going to go down. So you borrow from your broker, you get a credit, and then you buy back the stock at the cheaper price and just give that stock back to your broker. All right. So it's your boy, Mr. Fit to Flourish. Hopefully that made sense. And hopefully you learned something today. I'm outie. Good morning, welcome to the Fit to Flourish podcast. Let's talk wellness, finance, and growth.